Okay, hi. So we get to work on chapter 13. Now, remember, we talked recently about the difference between tax avoidance and tax evasion. And we said tax avoidance was using the tax laws to reduce your taxable income or your actual tax. Tax evasion was illegal. Well, chapter 13 is going to talk about a couple of ways that the government came up with to combat tax evasion. So the question becomes, why do we need rules for at-risk and passive activity? Well, assume that Abbott, Bart, and Calvin have some extra cash to invest. They also want to reduce their taxable income. So they each invest $33,333 into a partnership. The partnership borrows another $900,000 on a 10% interest-only, non-recourse note. And they buy some equipment that's equipment-intensive oil and gas venture for $1 million. The venture produces $150,000 a year in royalty income. So let's take a look at the next chart and see what happens. So we see that the income is $50,000 for each partner. We take the interest on that $900,000 note, so that's 900,000 times 10% is 90 grand. We divide that amongst the partners, and they each get $30,000, leaving them a cash flow of 20 grand. However, then we calculate depreciation on that $1 million of equipment times 15%. We get $150,000 in expense. We distribute that expense to each partner, $50,000, and they come out with a tax loss of $30,000 each. So by the end of the tax year, the partners would have received more cash and tax savings than the amount they invested in the first place. Because remember, they only put in 50 grand, or 33,000 rather. Furthermore, if the losses remained the same for year two, each partner would have deducted a total of $60,000 in tax losses from a venture in which they initially put in $33,333. That's the at-risk amount, the amount that they invested. So Congress established the at-risk rules to limit those losses. So what is at risk or increasing at risk? Cash and property contributions are at risk. A share of the liabilities is at risk, and income and gain items. What decreases at risk? Well, distributions of cash and property and release of liabilities. Form 6198 filed for each activity subject to the at-risk limitations. So the liabilities can affect at-risk amounts. You can have recourse debt. Taxpayer is personally liable for the debt. You can have non-recourse debt. That's what we talked about in that example. No individual is personally liable. And then we have qualified non-recourse debt. The taxpayer borrowed it with respect to the activity of holding real property. The taxpayer borrowed it from a qualified person or government. No person is personally liable for the repayment, and the debt is not convertible debt. All those must apply for it to qualify as a qualified non-recourse debt. So with regards to at-risk again, losses disallowed under the at-risk rules can be carried over indefinitely, and they're deducted in years when the at-risk amount increases. And of course, the losses are also subject to the passive loss limitations that we're going to talk about in a couple of minutes. So let's take a look at some questions here. Which of the following items will increase a taxpayer's at-risk amount? Is it a cash contribution made by the taxpayer into the activity? Yes, most definitely. The taxpayer's share of income from the activity? Yes. The taxpayer's share of the activity's liabilities for which the taxpayer is personally reliable? Yes. So the answer is D. All three of those would increase the taxpayer's at-risk amount. Which of the following types of liability does not increase the taxpayer's at-risk in an activity? The non-recourse debt that was pointed out in the previous slide. So let's talk about what is a passive activity. We talked about passive activity briefly a couple of chapters ago. Essentially, a passive activity is where the taxpayer does not materially participate on a regular, continuous, and substantial basis. Most rental activities, remember we talked about that, rental activities and limited partnership interests are passive by definition. We excluded under rental activities where the investor was a real estate agent and had an active participation. Passive activities for the taxpayer must meet any of these. Greater than 500 hours invested. All of the participation in the activity, obviously. Greater than 100 hours, not less than any other person. Greater than 100 hours and several activities that in aggregate exceed 500 hours. Be a material participant for any of the last 5 years of 10 years. You can see that these rules, there's not a whole lot to present about them. They're rules. They say this is this and this is that. Material participant for any of the last 3 years for personal service activity. So we're talking about accountants and lawyers and that sort of thing. Facts and circumstances. The individual participates on a regular, continuous, and substantial basis. General rule for passive losses, they're allowed only to the extent of passive income. Income or loss items separated into 3 categories. We have active income loss, portfolio income, meaning interest, dividends, royalties, capital gains, and then we have passive income or loss. Passive losses cannot offset the other two. Rental activities, as we said, usually passive, unless the person is a real estate professional. 6 other instances where rental is not passive. If the rental period is less than 7 days, 30 days or less, and significant personal services. Extraordinary personal services. If the services are incidental to non-rental activity. Customarily available during defined business hours and rented to an entity the taxpayer owns. So we have that connection. This is for lower income investors. $25,000 loss allowed for rental activities, even with active participation, own at least 10% of the property. It phases out when AGI reaches 100,000, not including the rental loss, and it's eliminated at 150. Disposition of a passive activity in a taxable transaction. So passive losses are allowed against non-passive income. Suspended passive losses are permitted. And gifts and inheritance do not trigger the use of suspended losses. So let's look at number 2. Rental properties are almost always considered passive activities. True or false? True. The general rule concerning the deductibility of passive losses is that they can be deducted only to the extent of passive income. That is also true. Number 3, for low-income taxpayers, passive rental losses can be deducted against other income up to a maximum of $50,000. True or false? That's false. It's up to $25,000. And finally, generally suspended passive losses can be deducted against other income when the activity is sold or disposed of. That's true. At-risk rules applied first, then the passive loss. Which rules are applied first to a passive activity, the at-risk or passive? The answer is, in order for a loss to be deducted, it must first be allowed under the at-risk rules. Once the loss is allowed under at-risk, the passive loss rules are also applied. Why must suspended passive losses from several passive activities be allocated among the activities? The main reason is that passive losses are allowed when an activity is sold or disposed of. Thus, if a taxpayer were considering the sale of a passive activity, he or she could lump all suspended passive losses on one activity and sell it. All of the losses would then be allowed, and the allocation to all loss activities would stop that abuse. So again, we're looking at rules that are trying to control the illegal activities that people do with regards to their taxes. If a taxpayer has AGI of $105,000 before considering a $23,000 loss from a rental activity, how much can the taxpayer deduct? Well, this comes to that $25,000 limit. So the taxpayer is eligible for $25,000. However, the $25,000 starts to phase out after $100,000. So since they're over by $5,000, we take half of that, and that's $2,500. Deduct the $2,500 from the $25,000, and they get a deduction of $22,500. Alternative minimum tax. Alternative minimum tax was created when the government started to see that very wealthy people were using the tax code to not pay any tax at all. So what the government said was, well, we're going to look at your taxes from two ways, and you're going to have to pay the highest one. So the AMT formula is take the regular taxable income plus exemptions and standard deduction plus or minus any adjustments plus tax preference items, and then subtracting the AMT exemption amount. Adjustments or limits on itemized deductions. The 2017 Act simplified the itemized deductions. Remember, after the 2017 Act, over 90% of taxpayers were taking the standard deduction and not itemizing their expenses. Medical, mortgage interest, charity, and miscellaneous, the typical itemized deductions are treated the same for regular and AMT. Only itemized deduction adjustment will be taxes. Taxes are limited to $10,000 on Schedule A, but no deduction is allowed for AMT, thus a $10,000 positive adjustment. Here's the depreciation adjustments for real property between 1987 and 1999. 40 years life for all real property for AMT. Real property after 1998, no AMT adjustment for real property. Personal property, again, 1987 to 1998. Longer life and method change to 150%. Remember, we've got those 150 and 200% declining balances for depreciation until we go to straight line. Personal property after 1998, method change to 150% declining balance only for AMT. Here's some other adjustments. Basis calculation for gains and losses, adjustments from K1s. Exemption amounts for 2021. Single was 73.6, married filing jointly 114.6, and married filing separately 57.3. The phase out, the exemption is reduced by 25% of AMTI in excess of income limits. And here are the income limits for that exemption. So number one, medical expenses are allowed in full for AMT purposes. True or false? That's true. No taxes are allowed as a deduction for AMT. That's also true. If a taxpayer is married and has 8 children, no exemption would be allowed for AMT purposes. That's true. And number 4, if a taxpayer's AMTI is $199,900 or less, AMT tax rate would be 26%. That's also true. And that's it for that. It's a pretty simple, straightforward, kind of short chapter. Again, we're getting towards the end of the semester. It's time, if you haven't yet, to come and ask me for help if you need it. If not, I wish you the best of luck for the week, and I'll see you next time.